Good morning, Jags. This is Fahad. Today is Tuesday, September 29th. Let's get started. Hey, Chronicle and Jay, how are you guys doing? Did you guys see this article in Wall Street Journal this morning? Only 10% of the workers have returned to offices as of September 10th, according to this Wall Street Journal article that came out this morning. Manhattan offices are nearly empty, threatening New York City's recovery. About 1 in 10 office workers have returned, far fewer than elsewhere, hurting local businesses. There is a 8-minute video that I'm just gonna, you can't hear it over here, but it's worth looking up and then watching this 8-minute video because it walks through exactly what's happening. And this is troubling. I mean, and I'm trying to think from my end as I watched this video this morning, what does it mean for so many businesses? What does it mean for real estate, commercial real estate? What does it mean for VNO, which is a large, commercial real estate operator that owns tons and tons of office buildings? What does it mean for example, if I go, so here is SPG, Simon Property Group. Take a look at this chart. Vornado Realty, VNO, SLG, which is SL Green Operating Partnership. I mean, these stocks may have stabilized just looking at technically where they have been, but this is just awful. What's going on? You guys have any quick thoughts on this?
I mean, immediately, when I did see this headline come across Twitter, and immediately SLG was the first stock that came to my mind because I know Chronicle has covered this before. I think I even wrote about this in Weekend Research way back when. So yeah, SLG is the one that immediately pops.
Yeah, and what if we get a bit of a pickup, which is already happening in Europe with, with the spikes in COVID-19 cases, even despite relaxation of rules? I think a lot of this is no longer because of shutdown. I feel like that a lot of the stuff that has happened is now structural damage in nature, where business have simply figured out new ways how to work from home, and it has become a new acceptable form. And life is continuing with that. And on top of it, there also continues to be voluntary effort on the people's part that do not want to return to work. I mean, this is reshaping the urban America, essentially, particularly in places like New York City. Chicago is going through the same kind of conditions. So this is just awful. And then I think about this, I mean, just random thought that started popping in my head. Starbucks is on every single block. So what does it do to Starbucks revenues in places like New York, Chicago, LA, and all of these places? They're driven by the traffic, the working traffic that they see everywhere. Hundreds and thousands, possibly millions of small businesses, from small restaurants to every single thing that's around in New York City. So, I mean, this has ramifications. I just don't know if it is fully factored in a lot of the stocks and everything. I just thought it was a fascinating story that came out, really troubling. Any quick thoughts, Chronicle?
So when I look at recent commentary from Boston Properties, management is still, I get the sense that they're saying what they hope to see rather than what's really happening. It's been one of the more frustrating shorts I've been fighting, but same thing on the San Francisco side. I think with the tech jobs and Silicon Valley, I'm seeing the similar commentary from that management as well. But when I look at channel checks from
here's a chart that you just shared with me, right? Work from home company tracker. This is from Jay. Tell me about it. What do you see in this, Jay?
Well, I mean, obviously tech to begin with, and then all the large banks, and how there's no definitive timeline for a handful of these companies, and if they do have a timeline right now, it's not until mid 2021 that they're going back to the office, but who knows at this point.
Yeah.
Sorry, the channel checks were from Zumper. So I have this right up on Essex Property here. So San Francisco is seeing double-digit declines in apartment rent because of the outflows of tech workers from Silicon Valley. LA is also being hit hard with 20% declines.
Yeah, I think San Francisco is the one that is getting hit the hardest here, simply for the fact that almost every job in downtown can be managed from home. But I think New York is the same way. When you think about an investment banker, think about, law firms, anything really, anybody can work from home. Um, eh, unless you work in the manufacturing capacity, what is the reason to be in the office at all? And the longer this thing continues, it's hard to become bulls on any of these stocks because they're sitting on mountains of debt. As you mentioned that Essex Properties, ESS, you just SLG, VNO, SPG, um, O, O is the realty income, SKT, Tanger Factory Outlet. We could just go down the list over here and it becomes very, very difficult. And I have a feeling that this is not just these businesses are impacted. They have ramifications for side businesses that depend on the traffic that they bring out. Like I said, Starbucks perhaps, and many other businesses that we have not even considered yet. But anyways, I thought that story was very interesting, something to keep in mind. I do have one stock I want to discuss real quick, which is AXSM Therapeutics, AXSM. Now, folks, keep in mind that many of you know that we have been bullish on this name for a long, long period of time, right? Way back here in October, November, this was a top pick in the fourth quarter of 2019 outlook when it had a monster run. The stock had a 500% gain in a single quarter, and that was made a top pick for that quarter. And then since then, it has flatlined and it's done nothing all year. And now here we are in September. It's still at the same place where it was last year in December. I bring this up because this stock is going to be under pressure today because Bank of America is initiating the stock with a sell rating, underperform or sell rating with a $66 price target. And the stock is currently trading at 76. So I expect a sell off of 5%, maybe even 10% on this name. And I think this is a downgrade, or this initiation note will keep a lid on this stock from appreciating any further. The main concern that Bank of America points out is that a lot of the launches that are going to take place in 2021, including the depression drug and the migraine drug, they're not very differentiated products, according to Bank of America. They're from the competition, and they also happen to be coming in rather very saturated markets. And so Bank of America is pointing out over here, so saturated markets, not very differentiated drug, and there's going to be, most importantly, three key readouts that are going to take place in the first quarter. Three key readouts that are going to take place in the first quarter of 2021 that could potentially hurt this stock even more. The first one is going to come from a privately held company called Lundbeck, which has a drug called Rexulti that will likely generate positive data of one of two prior phase 3 clinical studies, and it's a pivotal data, and it's going to be coming out in early 2021. The efficacy profile and everything is very much the same as AXSM Therapeutics. The second drug is going to come from Japanese company called Otsuka, AVP 786, and that's going to have similar kind of profile. It's been seen as a pretty strong candidate to gather some market share. And the last one is BioXcel, which has a novel approach, and it's very early in its clinical data points, phase 1 and phase 2 data only, and that's expected by the end of this year. And so that could serve as a negative catalyst for AXSM Therapeutics. So the stock closed at 76 yesterday, and if you look at pre-market, it's trading down about $2 to $3. I saw print as low as 74 in pre-market. So something to keep in mind, because if you're still positioned into this one, a large bank initiating with a sell rating with no catalyst on the horizon, it might be best idea to step aside over here and let this thing basically run its course of a corrective period in the short term. So just wanted to point this out. That's it from me. Jay?
All right, Pod. So today on my watch list is Corsair Gaming. Ticker is CRSR. This is a IPO that just debuted last week, last Wednesday to be specific. IPO price at 17. It did open lower with an opening print of 15.12, but over the last few trading days, it has rebounded and is now above 18. Who is Corsair Gaming? They are a leading provider of high performance gear and products for gamers and content creators. Let me just quickly share an image with you to give you an idea of some of the products that they do sell. So, I mean, this goes from keyboards, mice, headsets, gaming PCs, etc., as you can see from the image. Now, looking at their S1 filing, they are divided into two segments. You have gaming components and systems, which makes up 75% of revenue, and then gamer and creator segment, which makes up 25%. Now, within this segment, they do talk about their product offering and how it's enhanced by two proprietary software platforms, IQ, and then the Elgato streaming suite for content creators. Most of their products are sold either through online or brick and mortar retailers. So you have retailers such as Amazon, JD.com, Walmart, Best Buy, and as well as their direct online channel. Now, for Amazon, in 2017, 2018, 2019, and for the period ending June 30th, sales to Amazon have accounted for 17.7%, 22.4%, 25.1%, and 26.8%. So slowly going higher, and this is sales for Amazon, or sales to Amazon. Looking ahead, sort of to the remainder of this year, you do have Black Friday, Cyber Monday, Singles Day in China. That should help sales. You also have the introduction of new consoles, as we all know, so that should be another tailwind. And then in terms of overall revenue, when looking at the S1 filing, for 2017, 2018, 2019, and for the 6 months ended June 30th, overall revenue is 855 million, 937 million, and just over $1 billion. And then as of June 30th, they had made 688 million. So needless to say, it's on my watch list. I'll be keeping an eye on this one over the next few months, and you might see a full write-up down the road.
Interesting one. I'm looking at the revenue as you were talking. The 688 million for the first 6 months ending June 30th was up 42% year over year. And so over the course, so that means if I take 688 million, and for the sake of the argument, if I simply extrapolate that for the rest of the year, this company will do most likely about almost $1.4 billion in revenues in this year versus $1 billion last year. So tacking on 40% gain year over year, and then compared to 3 years ago, that's 100% increase, more than 100% increase. On the Amazon sales, they're not selling to Amazon. I mean, Amazon is not a customer, right? They're selling through Amazon. Am I correct?
Through Amazon, right?
Yes. Okay. And then this seems cheap to me with that kind of growth, 40% year over year, revenue base reaching about 1.3 to 1.4 billion this year, and a market capitalization of only 1.6 billion. It's trading at only 1.1 times sales. That seems awfully cheap to me. I wonder, if this is one of those sleeper IPOs that simply underpriced too much coming to the market. And the stock has been, in fact, reacting positively since it came to the market. So I would love to see what kind of write-up you come up with to dive more into it. But a very interesting pick. Seems cheap to me with that kind of growth rate. Interesting. CRSR is the symbol. Corsair Gaming. Chronicle?
Hey, Fahad. So to follow up on the West Coast and New York office situation, I have these checks from Zumper from my Essex property write-up.
Yeah.
We can see here that San Francisco 1 bedroom and 2 bedrooms are down mid-teens, but right below that we can see New York. It's down 11% for both 1 and 2 bedrooms. So that just a little more color.
That's the apartments. So it's negative across the board. Rental is coming down. Okay, interesting.
And that's for September, sorry. A quick update on Vertiv this morning, symbol VRT.
Yeah.
I first brought up this data center infrastructure provider 2 weeks ago, and yesterday Citi was out with a buy initiation, basically laying out everything in our bull case about the company, like how Vertiv is quietly a leader in those markets, and there's a lot more margin upside to be had because of the company's ongoing execution of its debt reduction and cost control plans. And because of that, they think the stock looks attractive trading at 12 times versus peer average of 15. And similarly, they didn't mention this, but price to sales is also ridiculously low because this stock is still very much under the radar, even though the company has been expanding a lot in Asia through its partnerships. And we did talk about this in our September 15th morning conversation. So as of
Yeah.
yesterday, there's now 3 firms covering the stock. B of A has a $20 price target, Deutsche Bank has 23, and now Citigroup is out with 21 with a buy initiation. So Vertiv's growth and considerable margin expansion potential is slowly starting to get noticed here. I mean, if management successfully executes on its cost reduction, we are looking at EBITDA margins going from 12% to 27% because they have said they are aiming for a 1,500 basis point improvement in margins. And this is a very experienced leadership team with close ties to Emerson Electric. And they also have former Honeywell CEO David Cote installed as executive chairman as a result of Goldman Sachs acquiring a stake in Vertiv. So they are capable of executing, I think.
1,500 margin improvement from 12 to 28%, from 12 to 27% over how long of a period? I mean, projected.
Over the next 5 years.
Okay. All right. So they're giving themselves plenty of time. That's still material, huge margin improvement, 1,500 basis margin improvement. Okay. Interesting stuff. I know that you're bullish on this one. We covered this previously as well, and these initiation notes also help. Chart is resting at trend support. This is a very defined channel. And so purely from a technical standpoint, this should gradually elevate from here, from near $17 per share to at least 19, in my view, over the course of next month or so, if it continues to follow this channel, so that we're expecting at least 10% upside. That means in the stock, purely technically speaking, but fundamentally with that kind of margin improvement and more color that you provided in the past, who knows, maybe we are truly underestimating the potential in the long run significantly. So we'll keep an eye on this one. All right, gents, thank you very much for joining. And Jax, we'll see you in the chat room shortly.